The spirit of innovation is deeply ingrained in America, and Google is helping Americans innovate in ways both big and small. The Air Force Research Laboratory is partnering with Google Cloud using AI to accelerate defense research for air, space, and cyberspace forces. This is a new era of American innovation. Find out more at g.co/American innovation.
Reality radio for a really great future. We're talking real money.
Well, you have questions, so we have answers. That's our job each and every day here at Talking Real Money. Hi, everyone. I'm Tom Cock. In just a moment, taking some more of those questions, which have been pouring in to TalkingRealMoney.com, and we are glad to take them, glad to help you any way we can. But before we start with Roxy Butner, I want to say congratulations to, well, not all of you, but most of you. This is really great news. Read recently that the average savings rate in 401k plans rose to a record high of 14.3% of income in the first 3 months of the year. That is actually pretty doggone good. That's a little less, at least according to this article in the Wall Street Journal, than the 15% annual savings rate that financial advisors often recommend over a 4-decade career. God, it's painful when you think about it, but because I only have a few years left. So the average savings rate has risen, by the way, from 13.5% back in 2020. So that's good. That's 1% more in that time. They looked at a bunch of clients Fidelity did at their 25,000 client companies. Here's the part that troubles me a little bit. That out of that 14.5%, it appears that 4.8% of that came from the employers and the rest from employees. So they're giving about 10%, and the employees, that's you listening, are giving about 10 for the employees and almost 5% from the employers. I would prefer to see you, the employee, putting in 15% and then getting the match. And I think our match is, and Roxy probably will ask her in a minute, is somewhere around 4%, because that gets you closer to the 20. I truly think if you did the 20 in the first years of your working life, you'll be in an amazing place. And by the way, people all the time tell me, well, I'm maxing out my 401k. Let's just make sure of that, because if you're under the age of 50, you can put in $23,500 into your 401k plan. That doesn't include what your company can put in there. Or if you're over the age of 50, you can put in $31,000. So this is good news overall, though. Glad to see the savings rate going up. And, part of the reason that we're on the air is because most of you have saved something, right? Because people always want to start with the investing part. And I say, don't forget, you got to set something aside first. And by the way, so Roxy's here with us. Roxy's one of our great advisors at Appella Wealth. I'm going to put you on the spot because this is a tough question. If somebody is just starting in their career, because it seems to come up a lot, should it be traditional 401k, like the pre-tax type where you get the tax break, which is people like, oh, I love that. Or should it be going into a Roth, post-income tax situation? What do you tell people?
I really love Roth, honestly. And so especially when you're young and if you're under that income limit, it should definitely be going into Roth, because it's not just that it's tax-free growth, but you really have to think about how many years it's going to be growing tax-free, right? So it's less, I guess, impactful if you're in your late 50s, early 60s, putting, money into the Roth. But think about that decades of growth that you'll get if you start when you're 20 or 30. And so definitely Roth. Yeah.
I mean, if you do that Roth, if you max that out, $23,500 for 10 years in your Roth, I think you could almost get away with doing nothing else after you're 30, whatever. And that would be a lot of money. Not telling you to do that, but I'm just saying you could get away with that. So, okay. Roxy taking time out from her busy day where she's talking to all of you on the phones, etc. And we've got some questions. What do we got today? I think we've got a lot of them been pouring in again to TalkingRealMoney.com. Keep them coming. We're glad to answer them. Go ahead.
These are great. So the first one is from Keith in Vancouver, Washington. And he says, Don and Tom, I'll start by saying that you two have broadened and deepened my understanding in personal finance while keeping me entertained. You've also increased my confidence in managing our family's portfolio during early retirement, so thank you. Here's my lengthy question. I hope it might be a question others share. Your perspective and advice are most welcome. So my wife and I recently retired. I'm 65 and she's 64. Have built a well-funded, fairly simple, diversified financial portfolio of low-cost index funds spread across IRAs, 401ks, about 65% of the portfolio, 2 brokerage accounts, which make up about 30% of the portfolio, and some Roth IRAs, which make up about 5%. We have allocated 75% to stocks. Within that, 25% international, 75% U.S., and then 25% to bonds and cash. It looks like less than 4% is cash, 21% is midterm and short-term bonds. So we're both delaying our Social Security until age 70. In the intervening years, we are living off investments from our brokerage accounts. And my question centers on managing our desired cash flow. The brokerage accounts have a year's worth of cash in a money market fund. The remainder of the brokerage account is in S&P 500, total U.S. market, mid-cap and small-cap value, and 2 actively managed balanced funds. At current values, the brokerage account can fund our cash flow for 7+ years. There is substantial risk to this time frame, however, when the stock market inevitably declines. All of the stock funds have many years of capital gains since we've held them for years. All of our bonds are held in tax-deferred accounts. What's a good way to manage our cash flow over the next 10 years? My plan is to maintain the current asset allocation and typically hold 1 to 1.5 years in cash. I would get this cash by selling stocks in my brokerage account, paying capital gains versus ordinary income if I take it from tax-deferred accounts. Then reallocating my total portfolio. I would continue to hold bonds only in my IRAs and 401ks. I wonder whether I should hold some bond funds or tax-free bond funds in my brokerage account. We are and plan to be in the 24% tax bracket, no state income tax for the next 10 years. What are your thoughts?
Yeah, there's a lot there. Great question. And it seems to me this most of the time is the question when we meet with you, because people are like, okay, I saved all this money. It's great. How do I get it? I mean, here's the way I would look at it, probably opposite of what you did. First of all, there's some asset allocation questions to me. In your brokerage account, if you have the S&P 500, then the total U.S. market, again, those 2 funds hold a lot of the same stocks. I'd want to pull all that apart first to make sure that my asset allocation, especially on the stock side, is fully diversified, holds all parts. And this year has been a good education around that because international, in fact, we just had our all-staff meeting and our trading team was pointing out that emerging markets and international have had big years this year. So you want to make sure you're properly allocated to those. So that would be one. Here's the way I would look at it, though, instead, Keith, and say, our target goal rate for taxation is 24. Now, how do we get the income we need out of that while not going above that? So it may be, in your case, that some of the money does come from the pre-tax savings, the qualified money in those, you mentioned IRAs and 401ks, then money out of the brokerage. And sometimes it might even mean a little out of the Roth. That depends on sort of playing all those buckets so that your tax rate never goes above that 24. And by the way, you asked about tax-free bonds. Probably at the 24% bracket, you don't need municipal bonds. The interest isn't going to eat you up there. But so that's, and again, in terms of how to create that, we believe in a total return kind of strategy where things go up, things go down. End of the year, you rebalance those, and you take some of that cash out and put it in your pocket. But so that would be my take, would be looking at the tax rate you're at and not going above that for as long as you possibly can, which may be a very, very long time. But what's your take?
Well, my first thought is you're not taking Social Security, you're only pulling off the brokerage, and you're still in that 24% bracket. So you must have maybe some other income coming in from somewhere.
Good point.
But also to think about, it's great if you can stay in that 24% bracket for the next 10 years. But what happens when RMDs kick in? Because that does make up 65% of your portfolio.
So maybe it's time for a Roth conversion in there somewhere.
Yeah, if you want to do a Roth conversion to save some taxes later on, and the question of whether to do that, of course, depends on what are your long-term goals for the funds, what kind of beneficiaries do you have, are you worried about leaving, tax-free assets to those folks? But yeah, I would look and see, because you might be 24%, but it might pop up to 32 plus once you get to RMD age. So exactly as Tom said, you might want to start taking a little bit now from the IRAs and see how much you can do to kind of stay in that 24% bracket, fill it up, and then take the rest from the brokerage account.
And if I could add something here, again, we try not to make the show a pitch, but you're a really good candidate to do two things. Number one, to have somebody really take a deep dive into your asset allocation, really to make sure that you don't have a lot of overlap, redundancy, because I feel like maybe you do. That would be one. And then frankly, after you develop, if you're a do-it-yourself or develop your plan, I'd probably go to a real planner and have them look at it and say, you forgot about this, you should think about this, because you're in a great place, but we don't want to overpay on those taxes if we can avoid it.
The other thing is this is really a year-to-year equation that you have to solve for. So you can try and set up a plan for the next 10 years, but the reality is at the end of each year, you have to look at where was my income and where am I in the bracket to figure out exactly how much more you can take. But yeah, I mean, aside from that, you guys sound like you've saved really well, and I think a little bit of tax efficiency in there will make things even better. Great
question, and congratulations again. Questions come to us from talkingrealmoney.com. Surprising. You just go to the Contact Us form, fill it out. Some people write a lengthy one, as Keith just did. Some people write them more briefly, like the next one.
Yeah, so this is from Robert in Pompano Beach. And he says, last child just graduated college. We have about $16,000 left in a 529 plan. Would it be better to leave it in the plan for a grandchild, roll it to a Roth, or take distribution and invest with less expensive ETFs?
That's an easy one for me because you just mentioned, we were talking, I believe, before we started the program, what it means to put money away post-tax. Roth, huge advantage. And now you can take money from those 529s up to the amount you can do each year for a young person, which I think is $7,000. That can go right out of the 529 into the Roth. That grows tax-free. You could do that for a little over 2 years here. I don't think there's any way you can do anything better with that.
Up to $35,000 lifetime cap. So it looks like in 3 years or so, you'd take that entire $16,000 and put it into the 529. Only caveat is they have to have earned income in that year that you make that rollover. And also the account has to be open for 15 plus years. So if it hasn't been, you could hold on to it. And then once that 15-year mark hits, then you could roll it into the Roth. Or maybe they don't really need it. They've got a good paying job. And at that point, if you haven't met the 15-year timeline, maybe you could just switch it over to your grandchild.
Yeah, I think it's, again, all the advantages to me. And if you do have a grandchild, then you start something new for that grandchild. I think for your child, huge advantage, running start to have that money in a Roth. We love a product like an AVGE or DFAW, total market. Expect hopefully 10% a year growth from that. And wow, what a great gift you'll be giving. Yeah. What else? We got other questions. I know they're pouring in. What else we got?
We've got Glenda from Loganville, Georgia. I am considering buying a car and I plan to pay cash for it. Once the costs and fees are added on and trade-in deducted, the final cost is around $35,000. The cash to pay off the car would come from my high-yield savings account, which pays 3.6%. There are two possible financing options from the dealer, 1.9% for 6 years and 3.5% for 4 years. Would it make sense for me to consider financing the car with one of these offers? I have excellent credit and should probably be eligible for either. I'm not sure how to compare pulling out my cash up front to making a monthly payment and leaving the cash in the savings account for the entire finance time or part of the time until some break-even time, if that even exists.
Yeah, this is a perennial question. We get this regularly. I have the money, but I could borrow it. Frankly, 1.9% is pretty cheap money. For me, the cutoff is always somewhere around 5%. If it's more than 5%, I consider it expensive. Less than that, I think it's reasonable. So I don't know the $35,000. I mean, how much of this would be pulling from your emergency savings? Because I don't want you to yank that out. You got to keep that there for whatever comes along. So, for me, 1.9, 6 years, if you're comfortable with it and the payments are a reasonable amount, I'm totally down with that. But some people say, I never want to get into debt because I don't want to owe anybody any money. That's another thing to think about. So I think this is more emotional than financial, but what's your take?
I think so too. But I do think 1.9% is really hard to beat right now. That being said, it's not like the money you had said kind of 5% as a cutoff. I would keep in mind if it's coming from your high yield savings, it is currently only earning 3.6. So that's kind of your cutoff for the financing rate you'd want to take. So I would do the 1.9% for 6 years, assuming you don't buy a car that's not expected to last.
Cars should, especially if it's a hybrid or electric, they should run for a long time.
Yeah.
What are you driving these days? I don't even know.
Got a Mazda.
Okay.
She's good to me.
All right. I love my Toyota hybrid. It's a plug-in, and I go home every night, plug it in, and I almost never buy gasoline now, so it's really a nice thing.
That is nice.
So I think, the 1.9 is cheap if you're comfortable with the size of the payment and the fact that you're going to have this for a number of years. If you're not, then I'd spend the cash.
And you can always pay it off. So if interest rates start to go down and your high yield savings is no longer paying over 2%, then you could just pay it off.
Yep, I think that's good advice. All right, we've got time for one more question here on Talking Real Money as Roxy joins me to answer your questions from TalkingRealMoney.com. Go ahead.
Here we go from Carl in Jefferson, Maryland. Hi, Don and Tom. Don, don't be so hard on Tom.
Oh, I love that. Thank you.
Love the show. I recently took the FINRA financial knowledge quiz and answered 6 out of 7 correctly.
Which I don't know. I got to look those questions up sometime. I don't know what they are.
Yeah. I did not consult the internet on any questions, and I wonder what % of people do, sadly. The question I got wrong was an interest rate versus bond question. The question is, if interest rates rise, what will typically happen to bond prices? Rise, fall, stay the same, or is there no relationship? I said no relationship because isn't a new $100 bond always $100? Shouldn't the question clarify buying new versus buying at auction, etc.?
Yeah, this is okay, but you said bond prices. So every day the price of any security is readjusted according to what people are willing to pay. And the change in interest rate and the connection to bond prices is a pretty easy one, actually, because if you buy a bond yesterday that's paying 2% and today someone wants to sell you one at 3%, pretty easy to see that your bond is worth less, right? Rates have gone up and people are going to pay you less for that bond. You're right. If you hold it till maturity, you're going to get your $100 and you're going to, assuming the person who got the bond is going to pay you back with the interest due, no argument there. But bond prices do adjust every day depending on the expectation, by the way, of interest rates, not just actually what they are, where they're headed. You've seen some really weird things lately with the 30-year U.S. government bond. So, yeah, they are connected at the hip, and that's exactly right. Interest rates rise, bond prices decline. It happens with regularity. So what's your take on all this?
Yep, I agree 100%. They're inversely related. Obviously, if there's higher paying bonds out there, then they have to adjust those prices on those older bonds that aren't paying as much and go down. So great job and keep up the good work and keep learning.
Yeah, I mean, I got to go take that test. But I don't want to not get all of them. I don't know where that is. I'll have to look that up. That's great stuff, Carl. And bonds. But again, holding the right type of bond, if you're short and intermediate term, you don't face too much rate fluctuation. Of course, you did in 2022. That was a bit of an anomaly. But in the big picture, keep the maturity short, keep the quality high, and so you don't want to go around and buy junk bonds, that kind of thing, where a lot of your portfolio, what you're really looking for here with bonds is stability, and the right ones will give you exactly that. What else are people asking you about lately when they come in the door?
Let's see. There's a lot of recently questions about inheritance or, making sure you have the right estate documents in order. That's been coming up a lot with my clients. So what happens when a parent becomes incapacitated, things like that. It's really important to get those documents in place. Make sure you have an estate attorney.
Yeah, that's something that we work on here closely with our clients because we do want you to be prepared for any eventuality. It's something that I always think I'm just going to check the box, but then I forgot that, and so it's part of life. You got to pay attention to it all the time. Make sure that you're updating things and doing that right. And I know you're doing that, Roxy Butner, and we appreciate you taking time out of your busy day advising one-on-one. If you want to talk to somebody like Roxy. Yeah, they're all on our staff here. You simply go to TalkingRealMoney.com, click on Contact Us, meet an advisor, and you just send in the form, and we do that. We will analyze your portfolio for free. You get to talk to an advisor at the end of that process. If you need additional help, then we provide it. If not, we wish you well and send you on our way. Again, that's TalkingRealMoney.com. Thank you again for joining us. It's always a pleasure. And, here we're going to be here every doggone day talking real money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.